Hello, and welcome back to Explain the Charts, your go-to channel for in-depth technical analysis. Today is November 25th, 2025, and we are taking a deep dive into the S&P 500 ETF, ticker symbol SPY. The markets are buzzing with activity after a week of intense volatility, and there's a lot to unpack from both the news and the charts. We've seen a massive rally over the past couple of sessions, primarily fueled by speculation about the Federal Reserve's next move. So, let's start by looking at the headlines that are driving this price action. The biggest story right now is the significant rebound we saw on Friday, November 21st, which carried over into yesterday's session. This surge was ignited by comments from New York Fed President John Williams, who suggested the central bank could cut interest rates again this year. The market immediately began pricing in a greater than 70% chance of a quarter-point cut in December, a massive jump in sentiment from the day before. This is a classic example of the market's sensitivity to Fed policy, as any hint of a dovish pivot can send equities soaring. However, this optimism comes on the heels of a brutal market reversal last Thursday, where an initial rally on strong Nvidia earnings completely fizzled out. This highlights a key tension in the market, the incredible strength of the AI sector versus persistent fears about stretched valuations and the Fed's stance on inflation. Barclays has even expressed continued fears of an AI bubble, questioning the return on investment for many of these high-flying tech names. Adding to the mixed signals, the latest consumer sentiment data came in quite low, with consumers frustrated by persistent high prices and weakening incomes. So we have a conflict, a market rallying on rate cut hopes while the average consumer is feeling the pressure. We're also heading into a holiday-shortened week, which typically means thinner trading volumes and the potential for exaggerated price swings. Now, let's see how this dramatic narrative is reflected on the charts. Looking at the daily chart for SPY, we can see a clear and powerful uptrend that has been in place for most of the year. After a significant dip and bottoming process back in early April around the 480 to 500 level, the market has been making a series of higher highs and higher lows. That April low is a critical long-term support level to keep in the back of our minds. The price has recently been challenging the all-time highs set back in late October, which sit just below the 690 mark. This 690 level represents a major psychological and technical resistance area. Before the most recent volatility, we saw a period of consolidation throughout August, September, and October, building a cause for this next potential move. Let's zoom in on the action from the past month to get a better feel for the current battle between bulls and bears. On this focused daily view, you can clearly see the brutal reversal candle from Thursday, November 20th. We saw a huge intraday swing of over 23 points, from a high of 675 down to a low of 651, closing near the bottom of the range. That was the market showing its anxiety about the Fed, completely erasing initial optimism from Nvidia. But look at the immediate response on Friday the 21st and Monday the 24th, two very strong bullish candles that have almost completely erased Thursday's losses. This powerful bounce occurred right after touching that key support area around 650. This demonstrates incredibly strong demand and dip buying interest, likely supercharged by those rate cut rumors. The price is now pushing back up towards the 670 level, a key pivot point from the past few weeks. To get a better idea of the intraday structure, let's look at the hourly chart from earlier in the month before this recent chaos began. On the hourly chart, looking at the first part of November, we can see how the price was building a range. It was chopping between roughly 670 and 685, establishing these levels as areas of supply and demand. This shows us that the market was in a state of balance and indecision before the major news events of the last week broke it out of this pattern. Understanding these prior ranges helps us identify where support and resistance may appear in the future. Now, to see the recent reversal in high definition, let's switch to the 15-minute chart. Here on the 15-minute chart, we can see the story of the past few days play out perfectly. Look at the waterfall decline throughout the day on Thursday, November 20th, a relentless downtrend with very little bounce. Then on Friday, the 21st, we see the market bottom out, consolidate, and begin its slow grind back up, reclaiming key intraday levels. The real fireworks happened yesterday, November 24th, with a significant gap up at the open. After the open, the price action shows a strong and steady uptrend throughout the day, a clear sign of bullish conviction. This short-term price action is extremely bullish and shows that, for now, buyers are firmly in control, chasing the market higher on the Fed news. The key is whether this short-term momentum can translate into a breakout on the larger timeframes. All right, let's bring it all together back on the daily chart and talk about what to look for next. Let's recap the key price levels. Major resistance is the all-time high area around 690. Immediate resistance is the high from last Thursday's reversal, around 675. On the support side, the first key level is the recent low around 651. A break below that would be a significant warning sign for bulls. Below that, we have stronger support zones around 630 and then down to the 600 level. So, what are the potential scenarios? The bullish case, which I'd give a 65% probability right now, is that this rate cut narrative continues to fuel the market. In this scenario, we would see SPY break above 675 and make a run for the all-time high at 690. A clean break and hold above 690 would put us into price discovery mode, which could lead to a very strong end-of-year rally. This outcome would be reinforced by any further dovish Fed speak or cooling inflation data. The bearish case, with a 35% probability, is that this is a speculative blow-off top fueled by thin holiday volume. In this scenario, the market could fail to break the 675 resistance and roll over. A definitive break back below the 651 support level would be the trigger, suggesting the bears have taken back control. This could be caused by the Fed walking back their dovish tone or any unexpected negative economic news. Key things to watch for are any statements from Fed officials and the trading volume as we go through this holiday week. Low volume can either lead to a quiet drift or sudden, sharp moves, so be prepared for anything. That's our breakdown of SPY for today. Please remember, this is not financial advice and is for educational and informational purposes only. Always do your own research and make investment decisions based on your own risk tolerance. Thanks for watching Explain the Charts, and we'll see you in the next one.